Lawmakers looking over the banking crisis at Silicon Valley Bank. We wanted to find out, though, what led up to that failure. Our Tom Miller sat down with Toby Burns of The Hill to give us some insight.
What happened at Silicon Valley Bank has been described as a bank run. Can you explain what happened here? What were the factors that led up to this?
Yeah, well, Silicon Valley Bank had a lot of capital there from venture capitalists and high-tech startups. And it takes that money and it invests it in various types of securities, bonds being one of them. Bonds are very highly sensitive to interest rate hikes. And the Federal Reserve has been hiking interest rates at a very rapid pace over the last year in response to higher inflation. So as those bonds became deflated in value, depositors at those banks basically started to get concerned about this and pull out their money. The bank had to sell some of its assets at a loss. And then as people kept trying to take money out and the bank kept trying to have to come up with ways to get depositors their funds, that basically led to a bank run.
And were these considered risky banking practices, or is this pretty mainstream?
Well, I mean, that depends who you are here. You know, the banking lobby has for a long time argued for deregulation. And after the collapse in 2008, you know, the Dodd-Frank Act put in a lot of greater safeguards, stress testing, capital requirements, that sort of thing. And that was rolled back somewhat in 2018 legislation. And actually, the banks themselves that just failed, they lobbied to get that rolled back. So it depends who you ask. It's risky, but you know, there's certainly an irony to the fact that they lobbied against this, and it ultimately led to their demise.
I'm sure there were other banks that were lobbying against this as well. Is there a good chance that we're going to start to see other banks fail this way?
Well, that's an important question right now, and I think the jury is still out on that because we're looking at levels of contagion, as they call it. You know, banks can mutually invest. There can be all kinds of, there's a shadow banking sector here, which we don't, you know, it's very hard to monitor and to see how interconnected those things are. You know, markets rallied yesterday, the markets dipped, then rallied, and now they're dipping again, the last I saw this morning. So, you know, market volatility and sensitivity here is very closely monitored. For the time being, it seems to be more contained, but obviously we don't have a definitive answer on that just yet.
And what are the politics of the Biden administration guaranteeing depositors money even more than the $250,000 backed by the FDIC?
Yeah, exactly. There's supposed to be a cap on these things at $250,000, and the Biden administration worked over the weekend and had a call with reporters on Sunday night, letting them know that all accounts, all depositors will be fully backed up. And that is definitely drawing criticism here. You know, why can we, I don't want to say break the rules, but sort of bend the rules when a certain set of investors finds their money at risk? Now, the Biden administration, by the way, has also said that, you know, investors in the bank will not be bailed out, and the management has been kicked out and the bank has been shut down. But yeah, it does raise questions. Why can people, you know, of a certain group get such a swift response from the government while, you know, others lag behind?
Toby Burns, economics reporter with The Hill. Thank you for your time.